Welcome everyone to the next show of CFO Inside TV. I'm very happy that you've joined us again, and I'm also very happy to have with us Rolf-Dieter Schwalb, CFO of Dutch Life Sciences and Material Sciences company DSM. Welcome, Mr. Schwalb.
Thank you.
DSM is undertaking some rapid and massive transformation, or has been undertaking for the last couple of years. You've bought companies literally in the billions of dollars. Yourself is a company of roughly 9 to 10 billion euros revenues, and you bought companies worth 2.8 billion, also divesting. So my first question to you is, you obviously seem to consider M&A as a means for quickly transforming your company. How happy are you with the progress that you've made?
We are very happy with the progress. It was by design, you could say, because we wanted to transform the company away from traditional chemicals to a more balanced portfolio of nutrition, which is a much more stable, high-margin business, and the more traditional materials, performance materials, chemicals business. And we divested some companies for that, and later we acquired, with those cash proceeds, we acquired a number of companies.
But M&A is still an inherently risky process. You can screen as much as you want. Still, a lot of acquisitions turn out afterwards not to yield the promised synergies or whatever one might expect. How do you make sure that you find the right companies?
Well, we know, of course, the industry, so we have good relations to many companies, and we select the targets with a very careful process. When we go for a target, we take really careful due diligence, so we take a lot of time, and if it really doesn't look perfect, we rather say no than progressing. So with the last 2-3 years acquisitions so far, we are very happy.
Prior to that, have you had an acquisition where you say, nah, wasn't that?
Yeah, I think if I look really long-term back, like 15-20 years, I would say one larger one really, in hindsight, maybe was not perfect.
Okay.
But the rest was all really, really good.
What in your experience, is the harder part? Identifying the target, financing the acquisition, or doing the post-merger integration?
Yeah, I think it's case by case different. Financing was not an issue in the last years because we first divested companies. So actually, end of 2010, we had a negative net debt. So we had a lot of cash on the balance sheet. And so financing was not the issue. Identifying, doing the process is, of course, because we take care, is important. And if you do that well, integration is easier.
You now have a very strong tilt towards nutrition. You just said that is on purpose. I think nutrition makes up roughly 50% of your revenues, but almost 70% of your profits. Why are the other segments slightly underperforming?
Yeah, the material segments basically are more related to general economic development. And of course, we all know that especially Europe is not doing well. North America, US, so-so, okay-ish. Asia better. But if the economy did much better, then also the materials businesses would perform much better. And nutrition is relatively independent of GDP developments.
You started a profit improvement program a couple of years ago, mainly to address the issues in material science, if I understand correctly. What's the main features of that program?
In fact, it goes across the whole company. So also there are nutrition elements in there. There are elements in the pharma business in that profit improvement program. There are more traditional elements like traditional cost reduction, but there are also more advanced steps like, for example, in my own organization, we go for a shared service center organization with a back office in India and front offices around the key regions. So that is transforming the finance function. That is also part of it. A similar project is going on in IT. So it is across the whole company with more traditional elements and more advanced elements.
Okay. You also kept turning more to your investor relations maybe, you've kept increasing dividends even though you have transformed the company significantly. So you had massive outlays for M&A, but you also increased your dividends. Why do you not keep more of the cash that you give out to investors?
Well, we have a very clear cash policy, how we apply cash, how we use cash at the company. Number one is cash for growing the company through own capital investments. Number 2 is at least a stable but preferably rising dividend. Number 3 is acquisitions. And that dividend promise, we are very strong on that. And a lot of shareholders trust in that and buy DSM share because of the dividend promise. That is also for us interesting shareholders in the sense that they tend to be the more long-term shareholders.
But your dividend is not relative to your profits, but it's actually an absolute promise on payout,
absolutely.
Right?
That's what it is. It's not a payout ratio, which would imply that dividends go up and down. We say at least stable, preferably rising, and we increase when we feel confident that we can at least keep the new level stable.
Well, but that, of course, means it will be challenging should revenues go down at some point, because that would be a double drain on your company.
But with the transformation of the company in a more defensive part, like nutrition, that risk is, of course, also much lower.
You have about 2 billion euros maturing in debt over the next 4 years, roughly. What's your long-term strategy for refinancing that debt?
Well, basically, we will see when we get there. So at the moment, we take more short-term debt. We go for commercial paper, for example, a very good financing tool at the moment. And the next maturity is in 1 year from now. And then when we get closer to it, we'll decide what we do. We have all the capabilities. We have a very good rating. We are rated A3 and A, respectively. And therefore, we have very easy access to financing markets. We have a good backup facility. So we don't see an issue. And we will see how we mix our financing. We have also prepared for potential financing directly in China with the so-called dim sum bond. We have not used it so far, but we could do it.
Was it hard to set up that potential?
No. It's relatively straightforward in the meantime. Some companies have done it already, and we could do it also any point in time.
So will we see a dim sum bond by DSM in 2013?
I don't think that we will do something this year because we don't need new financing. We do also at the moment not really want to do more sizable acquisitions. We first want to focus on integrating the ones we did and make them successful, and then we look forward again. Basically,
that dim sum would only be needed in case you found a suitable target in China.
Yeah, exactly.
Okay, thank you very much, Mr. Schwalb. As always, I also have 3 very short questions at the end, which I would like to ask you to answer with short answers, maybe yes, no. Do you think generally M&A is a suitable way of transforming a company?
Yes.
Have all your acquisitions so far lived up, under your guidance, lived up to the expectations you had in them?
Yes.
That's very... You're very happy man. And will you issue another bond in another not straightforward currency in the next couple of years?
Most likely not.
All right. Thank you very much, Mr. Schwalb. Thank you very much for joining us. I hope you had an interesting time with CFO Inside TV and with Mr. Schwalb, CFO of Dutch transforming itself company DSM. And I'm really looking forward to seeing you again next week for our next issue of CFO Inside TV.